Well, hello and welcome to 2026. My name is Ripley Atkinson. I'm the Australian Meats and Livestock Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian livestock industry to help the sector manage market and price volatility with our Australian feeder cattle swap. Today, I'm going to jump in and examine the recent announcement from the Chinese Ministry of Commerce on the 1st of January 2026 regarding the application of an out-of-quota tariff rate of 55% to be applied on beef imports from most countries that China deals with around the world. Now, there's been a lot of conjecture and a fair bit of uncertainty across the marketplace globally because of this development, and even more so here in Australia because of the nature of how significant China is as an exporting market for Australia. I'm going to start with the detail and the background to what has sort of transpired to give us this situation, and then I'm going to have a look at how that is going to potentially affect Australian cattle prices here domestically in 2026. But to start with the detail on this situation, what we've seen is in December 2024, China announced they would be completing an investigation into pretty much all beef imports from around the world that China receives. The import volumes that has gone into China over the last 5 to 10 years has risen astronomically. And there was a few key factors which China wanted to look at in regards to the rise in beef imports and what that meant. So the first one which they've identified was obviously to protect the domestic industry. Now, it can be debated as to whether that imports have a material effect, particularly from Australia and countries of the like which send high quality product into China. But the Chinese Ministry of Commerce nominated the fact that they wanted to better protect the domestic industry and also stabilise domestic production as two key reasons for this investigation. The second one was to reduce the reliance on imports, and that obviously ties quite nicely into stabilising domestic production. So on the 1st of January, that announcement was made, and each country or most countries which export to China or import to China received notification of what their 2026 tariff would be. So for this year, Australia's quota of beef exports to China, all beef exports excluding offal, was 205,000 metric tonnes. Now, once that quota limit of 205,000 metric tonnes is exceeded, a 55% tariff rate will apply on any product exported to China outside of that amount. Now, a lot of other countries received quota limits themselves, but for Australia, if we look at that specifically, it ultimately renders the Chinese market unprofitable and not possible to export to because of how significant that 55% is. Other countries, namely Argentina, New Zealand, the USA, and Uruguay, now they receive far more favourable quota limits relative to what their calendar year 2025 export volumes actually were. And what I mean by that is the quota limits are far higher than the actual volumes they shipped to China last year. And for a number of reasons, their volumes across those countries I mentioned were lower. Now, Brazil and Australia, traditionally accepted to be the two largest exporters to China, have been most impacted by this amount. So in 2025, we exported 272,000 tonnes to China, and our 2026 quota limit is only 205,000 tonnes. It gives you an idea on how straining that is on Australia as an example, relative to some of the other countries which have enjoyed a better, more flexible and a higher quota limit ultimately. So why is this situation important? Well, China is a major market of Australia's. As I mentioned, last year we exported 272,000 metric tonnes of product. It was the second highest calendar year for China on record, and export volumes to China grew 41% year on year. So it's a major market of ours, second largest market overall. It accounted for 17.5% of our total exports. So it's a really key market. But what I really want to mention here in specifics, and I get into a little bit more detail in what it means domestically, but China in 2025 was our largest market in total for grain-fed beef exports, and grain-fed beef as a share of China's total exports accounted for 55%. So the reason I give you those statistics is because what it's telling you is China is a major market of our grain-fed product. Grain-fed product is really high value, and that's important because it obviously drives significant revenue generation throughout the supply chain. So it's a key market overall, but it's a really key market for our high-value grain-fed product. And traditionally, the value Australia's been able to extract out of China on a dollars per kilogram basis has been higher than some of the other markets that we export to. So it's quite a key market in the sense of grain-fed product. Now, if we look at what that potentially may mean domestically for cattle prices here in Australia in 2026, there's a couple of things. The first one is that reduced impact, or that impact of reduced access to that really highly valuable Chinese market is going to influence buying behaviour here domestically from brands and feedlots, exporters, processors and the likes. And what I mean by that is as feedlots begin to get market signals from the exporters that the capacity to supply the Chinese market is effectively gone because we've hit that quota limit and we need to move that product elsewhere, we may have to accept a lower price point from other countries purchasing that product. If that were to be the case, there would be signals flowing from the exporter back to the processor, the feedlot, and ultimately the feeder price or the cattle price that would suggest a lower price has to be accepted. Now, alongside that, if that were to be the case and the likelihood that Australia fills its quota in early Q2 of 2026 calendar year, feedlots would begin to cycle out of buying and preferencing cattle that are suited to the Chinese market. Now, what I mean by that is HGP-free stock or hormone growth promoting free, long-fed Angus or Wagyu. And if they moved away from those stock, it would be likely that HGP-treated cattle or shorter-fed cattle would be better suited to utilise that feedlot infrastructure, so feedlots could obviously utilise that asset, and it would also allow for better market access. And as a part of that, that would encourage downward pressure on those more China-specific animals. And what that ultimately means is pressure on those prices alongside some cyclical domestic factors around profitability within the supply chain of those types of animals that was already occurring structurally. And on the flip side, it looks like there could be some support for shorter fed cattle or hormone growth promoting treated cattle, which have got better market access to an array of other countries, and it's more in demand around the world. This is a very evolving situation, and it's one we're going to closely monitor here at the StoneX Australian Meats and Livestock Desk in 2026. But that's all for this week. If you'd like to hear more about this and anything else on the Australian cattle and beef markets, make sure you jump onto your listening platform, Apple or Spotify, and search up the Australian Cattle and Beef Market Report by StoneX. This is our fortnightly podcast. We release it every second Friday, Australian time. I jump in with guests and on my own and discuss how prices, supply, demand, beef exports and other factors are influencing the Australian cattle market. Make sure you subscribe to that or this episode. Other than that, until next time, take care and we'll see you then for more content. Cheers.